We're looking at still First Republic, that their shares were halted at one point today, continuing to sell off though. But at what point should the Fed and should regulators say, look, this bank should be allowed to fail? Because obviously they're thinking of systemic risk, moral hazard, all these different thresholds. At what point do you say enough is enough and really let a bank fail?
Well, I think we should be doing that more often. But when we do, that's why I've suggested changes in the way the deposit insurance system operates, because if we do let those banks fail, we do need to protect the people that need to be protected when that bank fails. For example, we protect all depositors that are under $250,000 because we feel that the smaller depositors don't have the means to really examine a bank and be careful about where they're putting their bank and so forth. Where the larger depositors, they can make those judgments. But even on the largest ones, we shouldn't take all of the money out of the system. We should leave most of it there. I suggested that we pay 80% of the largest depositors, 80% of their money immediately. It comes from the Fed immediately, and then the FDIC will reimburse the Federal Reserve. And then as we collect the assets of that bank, of the failed bank, and we recover some of that 20% that the depositors did not get, then we give them that money as well. So they may wind up losing nothing. They might have to wait for a while. So it's things like that, and covering payroll accounts so that innocent people who weren't even depositors in the bank are able to get their payroll checks and not have them taken from them. If we do things like that, then a bank failure is not the end of the world. It's a relatively minor disruption, and it clears out banks that don't belong in the system. And I think that if we do something like that, we'll have a much better banking system, in my judgment.